Hi, welcome to the second day of MIC IVCA Conclave. I hope that you had an interesting and insightful session yesterday. We had deep dives into sectors like telecom. We had perspectives from LPs on the VC ecosystem in India. We had views on the infra story that the India is panning out, and we had the honorable finance minister and marquee leadership from India like Mr. Uday Kotak also join us. So I hope that was insightful, and you're looking forward to day two as well. We will start this day by a welcome address from Mr. Sujoy. We'll start this address by Mr. Sujoy Bose. He is a business leader with over 3 decades of extensive experience in emerging markets, investing in project finance, covering infrastructure, industrials, and services sector. He's the managing director and CEO of National Investment and Infrastructure Fund (NIIF), and he's joined NIIF as an MD and CEO in 2016 and is currently based in Mumbai. Before NIIF, he spent over 25 years at IFC, the private sector investment and financing arm of the World Bank Group. He's also an executive council member at IVCA. With that, I would like to welcome Mr. Sujoy Bose on stage to deliver a welcome address.
Thank you, Rohan. And ladies and gentlemen, it's a great pleasure to be able to start the second day of this great, excellent conference that IVCA has put together. This first version of the Maximum India Conference is happening during a very important year for our nation. We are celebrating the 75th anniversary of our independence, and of course, the celebrations have started. 75 years as an independent federal democracy still feels young, but it is quite remarkable what India has achieved in this short span of time. In 1951, which was actually the first year of official economic data, India's GDP was $21 billion US dollars at current prices. Our population was around 350 million, which means GDP per capita was around 60 US dollars, 60. Our literacy rate was 18%, and 45% of the population lived in poverty. The last 75 years has brought about a remarkable transformation. India now has the fifth largest economy in the world, with a GDP of 2.6 trillion US dollars and GDP per capita of over $2,000. Literacy is over 80%, and we have made great strides in reducing poverty in our country. Having worked across the world, I have always been a student of inflection points, and have observed in other countries that a sustainable GDP per capita of around 3,000 US dollars can be an inflection point both for growth and prosperity. When I say sustainable GDP, I mean that the GDP is not made of cyclical commodity exports or due to short-term capital inflows, but is led by the power of a strong domestic market and is built on the back of strengths that make the economy globally competitive with solid institutional capabilities. At the pace of the current projected growth rates, India will get to that inflection point of $3,000 per capita in the next few years. In 1947, the founders of the modern independent India based our future on the strengths of individual freedom, a strong spirit, and the willingness to partner, learn, and grow. Today, we have not only built on those strengths, but from an economic point of view, we have emerged with many more strengths. The young, dynamic, hardworking citizens of India make up a demographic profile that is second to none. Entrepreneurship flourishes in our country and will be the backbone of growth for the next many years to come. 30 young companies reached the status of unicorns this year, and the year is not yet over. And by the way, last year, 38 unicorns had been formed. Our education system produces world-class engineers, scientists, economists, healthcare professionals, and leaders. We have developed the ability to find low-cost solutions to many problems thanks to our bright young problem solvers and the scale of the domestic market, which is one of the largest in the world. I could go on, but one item that adds to my inflection point theory is India's digital stack. that enables a highly inclusive financial system with numbers of digital transactions setting new records on a monthly basis. Within this environment, as the private equity and venture capital industry in the country reaches its third decade of maturity, this industry will play a crucial role in the future growth of the country. A report by McKinsey a couple of years ago found that private equity played a pivotal role in the development of small and medium enterprises and critical industries, spurred job growth, and facilitated the development of strategic capabilities in India. These characteristics were demonstrated by several data points. PE-backed companies grew faster than others in job creation, revenue, and profit growth. Exports by PE-backed companies grew about 60% faster than others, demonstrating that PE investors helped these companies gain strategic advantages at a faster pace. And the report said that a big advantage of PE investment that is not highlighted often enough is the governance dividend, something that has become a crucial factor for investors all over the world. Over the last decade, Indian PE and VC managers have substantially improved their track record, their institutional structures, and are starting to scale towards and beyond the $500 million, $1 billion fund size mark. That is a crucial inflection point for the industry. It is important to remember that many of India's recent entrepreneurial successes and national champion companies were funded by private equity from an early stage. Several of India's IT services giants were private equity funded, as were many of the pharmaceutical companies, two sectors where Indian companies have become world-class. In the infrastructure sector, telecom companies, telecom tower companies, renewable energy companies, airports, and roads companies are in many cases funded by private equity, and investors who have participated in these investments through the private equity managers have benefited from strong growth, good governance, and excellent returns. I am fully confident that the PE industry in India will not only continue to play a key role in the growth of Indian companies, but will be an important factor in India's inflection point to higher growth as an economy by enabling efficient allocation of large-scale capital to worthy long-term investments. Within this industry, we at NRIF see ourselves as not only connecting long-term patient capital to investments in critical sectors of the economy, but also by engaging with investors, many of whom are new to India, to help them understand the big opportunity that India provides. For example, as the government of India's monetization plans for infrastructure is implemented, India could be one of the largest markets for operating infrastructure assets outside OECD countries. A great opportunity for large institutional investors who are seeking these kinds of investments. And finally, in addition to working with investors, NIIF is also working with central and state government agencies and regulators to provide a neutral perspective on actions required to make our investment environment even more interesting for foreign and domestic institutional investors. I will end with one area that we all need to work on with all our energies, and that is in enabling domestic savings that are entrusted to the local pension and insurance industry to start taking risk in the alternative asset sector in India. Domestic savings in India are over $500 billion a year. Currently, AUMs with large pension and insurance funds in India are in the range of $1 trillion, growing rapidly, probably one of the fastest growing pension insurance systems in the world. We must work in encouraging and helping the government, regulators, and these institutions to allocate more and more of their capital to alternative assets. This has been done successfully by the leading institutions around the world and has proven to be a win-win for their economies and their citizens. IVCA and its members will play a major role in this exciting opportunity by understanding the requirements of those organizations and developing institutional capabilities, risk management processes, and investment strategies that can enable this transition. It will take some time, but I am confident that we will succeed, and this transition will release much needed long term capital for our entrepreneurs and for our national projects under the stewardship of Indian fund managers. With that, I would like to congratulate the IVCA team for putting together an excellent conference. The day today is as exciting as yesterday. There are some amazing speakers and a couple and three very interesting panels that I'm looking forward to listening into, and I'm sure all of you will as well. Many, many thanks for giving me this opportunity to address all of you. Thank you very much.
Our youth are one of the largest users of the app economy. Thus, if you want to invest in startups with a huge markets, come to India. Our infrastructure creation is expanding at a fast pace. Thus, if you want to invest in one of the world's largest infrastructure ecosystems, come to India.
Huge influx of FDI, 25 new unicorns of the 60 have been born in this year, and we are very excited by what the future beholds over this decade. We welcome all of you to the Maximum India Conclave in early October to come and witness this for yourself.
Good evening to all of you again. Good evening and good morning. I now have to perform my most important task for the day, which is to introduce our next speaker, who plays a very important role in steering India closer to the $5 trillion economy that we will be seeing. Dr. K.V. Subramanian, currently Chief Economic Advisor to the Government of India, is a leading expert on economic policy, banking, and corporate governance. A PhD from Chicago Group and a top-ranking IIT IIM alumnus, he authored the path-breaking economic survey that commenced ethical wealth creation for prosperous India. By integrating India's rich economic and spiritual heritage with modern economic ideas, he advocates ethical wealth creation through marriage of the invisible hand of the market with the hand of God. Dr. Subramanian has got several ideas to implement welfare programs for the behavioral economics of the health is acknowledged for its potential to bring behavioral change. His idea of polynomials, what a common person pays for a vegetarian or non-vegetarian colleague, has been framed as India's Big Mac Index. Combined with the idea of the bare necessities index to measure the reach of water, sanitation, and patient housing of citizens, these ideas enable robust measurement of the risk of the reach of well-populated. Dr. Krishnamurthy is a lead in the Indian School of Business, where he was a professor of finance. Dr. Subramanian has been conferred with distinguished alumnus of Lord Harvard, alma mater of the country. Apart from being the youngest chief economic advisor, Dr. Subramanian is also the youngest to receive this honor from the alma mater. So the theme of a young and dynamic country is well embodied by the people speaker today. And in this case, I would add that he is very wise, passionate, and insightful, and I'm proud of the fact that he was involved in 2 years in the Calcutta. So with that, Dr. Subramanian, please.
Very good evening, and thank you very much to IVCA for inviting me to share my thoughts. I think if we look at the overall economic recovery, the way it is proceeding now, our prediction of a V-shaped recovery that we had made at the most difficult point, that Indian economy has faced, which was last year after the first quarter decline of 24.4%. At that time, we had made the prediction that there is a V-shaped recovery that is on. We're glad that that is indeed transpiring with 7.5% in Q2, decline, 0.4% growth, and 1.6% growth in the third and fourth quarters, and then followed by 20.1% growth in the first quarter. And overall, if you look at second quarter that just finished of this financial year, the high frequency indicators seem to suggest that the recovery is actually going on very robustly. This is reflected in our tax revenues, and also if you look at the high frequency indicators, like for instance the purchasing managers index, both for services and for manufacturing, a lot of other indicators like e-way bills, the power consumption, sales of commercial vehicles, etc. So I think overall the recovery is proceeding very, very well. Day before yesterday, Moody's also ascertained that, and typically rating agencies, are usually behind the curve, unlike investors. And I think, as we had highlighted, in the economic survey this year, with respect to India, these sovereign rating agencies have typically been, gapingly behind the curve, and yet for them to have acknowledged the change in the ground situation, the improvements through the change in the outlook, I think is vindication of this robust economic recovery that is on. Let me focus on the important drivers, that has led to this recovery. I think the reforms that India has done over the last 18 months, I think, have played a very, very crucial part in this recovery. While every other country was focusing on just tiding through the pandemic, India, as is generally the case, has converted this crisis into an opportunity by ushering in path-breaking reforms across several different spheres. I'll talk about them briefly. But let me, lay out what is the changed economic thinking now that India is adopting. Think about this change in the economic thinking, the new economic thinking, as a three-pronged, a triangle or a three-leg tripod, which has the following three features in it. First, in terms of the objectives, an exclusive focus on growth at the macroeconomic level, combined with efficient welfare programs at the microeconomic level, to ensure that not only are we growing the pie, but at the same time also distributing the pie in an equitable manner. So I think that's the first leg of this changed economic thinking. The second, and this is a very seminal and in my opinion durable change that has come about in India's economic thinking. Given our socialist past, for India now to have embraced wealth and wealth creation, created ethically, built ethically, for us to have embraced that is, I think, a very, very seminal change. As I will explain, it is part of India returning back to its DNA, something that I have genuinely believed in. These ideas of socialism and communism were actually never Indian economic models. They came to us from Western economies. If you go back to in history over the last 2,000 years, India has actually been an economy that has pursued dharmic capitalism. And I think that's India is now returning back to that. So that's the second key change. Privatization, asset monetization, the enterprise policy focused on the private sector, enabling of competition in factor markets. All these are part of this exercise in treating wealth and wealth creation as a boon and not as a bane. Finally, and this is the third leg of this important change in economic thinking. It is the virtuous cycle, focusing on the virtuous cycle starting from private investment. And that is really critical because historically, if you look over the last 100 years, every country that has grown at a 5% real growth rate for at least a decade. So, not ephemeral growth, but prolonged growth, prolonged high growth, 5% plus in real terms over at least a decade. Such growth has happened only on the back of accelerated private investment. So that is something that even for India, if you look at before the global financial crisis, India's growth also happened when our private investment actually started, or aggregate investment in the economy touched close to 40% of GDP. So that is the third key leg, and that is supported by government capital expenditures. Government's fiscal policy is actually focused on capital expenditures, not just on revenue expenditures, and supply side measures, supply side reforms to sort of crowd in private investment. So this is the important change that is happening in India's economic thinking. Let me give you the how this difference in policy is actually impacting the macroeconomy. When one looks at the macroeconomy, typically three key indicators matter a lot, which is that's inflation, the current account deficit, and the fiscal deficit. So let me give you the contrast vis-a-vis our response to the previous crisis, the global financial crisis in India itself. So within India, I'll contrast the global financial crisis, the outcomes that we had in terms of these three indicators vis-a-vis now, and also contrast our policy response and these indicators vis-a-vis the rest of the world. So let me first contrast vis-a-vis the global financial crisis. In each one of these three indicators, after the global financial crisis, we performed very poorly compared to our peer economies. For instance, current account deficit went to close to 5% of GDP, when typically 2% or less is what is taken as comfortable. So we were actually way above the tolerable levels on the current account deficit. Inflation, following the global financial crisis, we had double-digit inflation touching close to 14%. And that is, do remember, that is without any lockdown, without night curfews, without restrictions, that have been placed because of the pandemic. So, without any of those supply side disruptions that have been created now, even without that, we actually had 14% double-digit inflation for several months, actually more than a year. In contrast, actually, if you look at in the current period, inflation has been 6.1% last year. That is with these enormous supply side disruptions that have come about due to the pandemic, lockdowns, night curfews, etc. And now after 2 months of inflation being a little higher than 6% during the second wave, for the last 3 months inflation has trended down, and it is actually at 5.3%, comfortably within the range of 2 to 6%. If you look at the current account as well, unlike close to a 5% fiscal current account deficit, which was close to perilous levels, India has had a current account surplus in the last year and in the first quarter of this year as well. And this year's current account surplus actually is close to the highest in many years. When you look at the third metric, which is the fiscal deficit, and here we have to actually in reading these numbers, we have to take into account that overall across the globe, fiscal policy has become very important in responding to the pandemic. Yet even though pandemic with not that much fiscal space, India has spent very prudently. If you look at our fiscal deficit, the central government's fiscal deficit at 9.2%, it compares quite favorably with our peer economies, which have an average of 10.5%. I'm quoting from the IMF Fiscal Monitor. In contrast, during the global financial crisis, the period after, when the global peer, when our peers, emerging market peers, were at 2.5% fiscal deficit, we were at 6.5%, so 2.5 times more. And what is the key policy difference that led to these different outcomes? If you look at the period, following the global financial crisis, as it is with the current policy push in the in the rest of the globe, it was primarily Keynesian demand side measures, which is the usual Keynesian argument of during a crisis, do revenue expenditure, and he used to state it as it's okay if you make people dig holes and fill it. And I think what we have to understand, and this is where India's policy response is quite different, is that you don't create assets in the process when you make people dig holes and fill it. In contrast, there is, of course, equally famous, the Hicks-Samuelson accelerator multiplier, framework, which emphasizes capital expenditure and the multiplier effect that capital expenditure, creates. So India's response has been more along the lines of the Hicks-Samuelson, framework, rather than just plain Keynesian, just focusing on revenue expenditure. And I think that is very critical in understanding, not only what has transpired so far, but what is likely to transpire going forward as well. I think, this is, most undergraduates learn in their first economic classes that if you only increase demand, keeping supply the same, stagnant, you have price increases, you do have quantity increases for sure, but that is accompanied with price increases. In contrast, if you expand demand, but at the same time also expand supply, then you actually can keep the price level unchanged or not increase that much, and generate a much bigger increase in the quantity as well. And this fundamental sort of thinking from first principles, supply and demand never go out of fashion, I guess, for an economist. I think that is really important. That prism is important to understand why India's the macroeconomic outcomes are so different in a salutary manner compared to the global financial crisis and the rest of the world. If you look at the rest of the world, global inflation is rising a lot. Supply side frictions are biting, whether it is on the power side. We've just seen in China the supply of power actually becoming a big problem compared to demand. Similarly, commodity prices rising a lot. Exports being impacted, global exports being impacted by shipment containers not being available. These are all illustrations of supply side frictions. Why do you have supply side frictions? When you only focus on demand, just implement the Keynesian prescription of basically just doing demand side measures. Of course, supply will start biting because you've not done anything on supply. And that is what we did, following the global financial crisis. That's what the global economy has done, following the COVID crisis as well. And India has been very different in this, because very early on we recognized that the COVID pandemic, because it will involve, economic restrictions, will have supply side impact, and therefore it is very important to take supply side measures. And I must give credit to the decision makers who actually must be credited, because supply side measures are far more difficult to do, because the impact of that comes with some lag. Now I think the impact has been very, very quick, because the crisis itself is a supply side crisis and a demand side crisis, of course, through earnings, but supply side is immediate because of the restrictions. Demand side actually, I think, caters to populism very well. So that's oftentimes very easy to pull off in democracies, but supply side measures are far harder and requires courage of conviction to do. And I think that's where, the decision makers need to be given substantial credit. It's one thing for us to recommend, another thing for it to be actually done with the courage of conviction. So I think that's where India has been really different in focusing on supply side measures, identifying it, and thereby actually acting on that. And that is what is really responsible for for these macroeconomic fundamentals looking much better. In terms of the impact on growth going forward, I think what is very important to remember, again, you will see this globally, and you saw this in the Indian context after the global financial crisis as well, is when you do only a demand side push, of course you increase quantity, so GDP growth goes up, but you actually have inflation as well. And when you have inflation, then monetary policy has to actually try and push back demand. So what happens then is the positive push that fiscal policy gave to demand, monetary policy has to unwind that. That's what actually happened after the global financial crisis in India, where series of rate hikes, monetary policy tried to actually bring down demand to bring inflation in control. That is what indeed happens when if you're only doing demand side measures without any supply side measures, you will have price increases. Therefore, monetary policy has to actually work at cross purposes to fiscal policy. In contrast, if you do demand side measures and supply side measures, then the price level does not increase as well, and so monetary policy and fiscal policy can actually work synergistically. And that is what actually we are seeing in the Indian context, unlike in the global context, and unlike what happened after the global financial crisis. So the growth impetus therefore can actually be much more long lasting and not ephemeral as it was following the global financial crisis. So I think this is a very important aspect. Even with the tapering that may happen both in the domestic front and with the Fed, I think our fundamentals are quite strong, and we've taken the necessary measures, and we've had the courage to be actually different, not just follow the herd in doing Keynesian policies. Actually, I think, and that is enabled by the necessary clarity of thought in pushing for supply side measures. A couple of other important points. I think this is especially for the audience at IVCA. If you look at the policy push over the last last 7 years, what really stands out is the emphasis on competition, enabling competition in the Indian economy. Whether it's labor market reforms, whether it's actually the opening up of several sectors, the farm bills, the enterprise policy focused on the private sector, the policy of asset monetization, the recent telecom sector reforms, all of these are the main idea that is driving this is that we have to actually enable competition, especially in factor markets, and that is what is at least in part responsible for the for the startup economy, the way it actually is now shaping up. If you recall, in 2014, the startup economy was gasping for breath, and it was gasping for breath because of the crony policies, the crony lending that was actually being followed, which is antithetical to competition in the economy. And entry through startups is, of course, one of the key ways in which competition is enhanced in the economy. So the emphasis, whether it's through the IBC, through many of these reforms that have been done, emphasis on competition, and I think fair competition is actually something that is really important. We have a long way to go, on this, but I think these are very important steps that have been taken in enabling competition in the economy, and that is what why we are seeing these, now 100 plus unicorns that have been created. Last part that actually on the new firm creation itself that I want to highlight, some recent data suggests that if you look at the new firm creation in manufacturing, over the last 5-year period, the new firm creation in manufacturing has tripled. In 2017, it was 15,000. Annually in 2017, about 15,000. 2021, it's 41,000. So close to 3 times. And just in the last 2.5-3 year period, 2019, it was 18,000. Now from 18,000 it has increased to 41,000. So I think that is very important, and this is not just existing firms breaking up or creating. This is widespread, because you're having if you look at the top three states, that the proportion of new firms in manufacturing we created, that proportion from close to 50% has come down to about 40%, with new states joining in as well, which is illustration of this new firm creation in manufacturing actually spreading. And I think that is also part of the entire policy push focused on manufacturing. So overall, with all these reforms, I would say that India is poised for high growth and inclusive growth through job creation, especially in the organized sector going forward. So our projection is that this year, with a high likelihood, we should have double-digit growth. Next year, we anticipate between 6.5 to 7%, and then as the impact of reforms start kicking in, growth accelerating beyond 7%. And I say this based on the fact that pre-crisis India's potential growth was 6.5%. We did 2 years there was an impact because of the financial sector problems. So now that those financial sector problems have been fixed with a lot of reforms, I think potential growth should be in excess of 6.5% because of the reforms. So you take baseline of 6.5%, add the impact of reforms itself, which will impact investment and productivity in the economy. So potential growth should be closer to 7% or maybe more than that. That is what I anticipate as the growth rate for India going from FY24 onwards. So I think this decade, actually, given these seeds that we have sown, the fruits of it will fructify in this decade. Should be a decade of inclusive growth and very positive inclusive growth for India. I'll stop there. Thank you very much once again to the organizers for inviting me to share my thoughts.
Indeed, it will be, sir. And thanks for those encouraging words. It's good to know for the audience that how we've thought about the recovery and how we've used policy not ephemerally, but using the capital expenditures and aggressive approach to have a V-shaped recovery, and the landscape that we've brought on board to create a very competitive environment for people to grow or companies to grow. So it's really good to understand this ideology. And thank you. On behalf of IVC, I would like to thank you for taking out time from your busy schedule and sharing your thoughts with us. Thank you so much, sir.
Thank you.
Thank you.